Good evening, students. Good evening to all of you. Jyoti, Kavita. Students, we are into one of the now most important topics, students, and that is about the composition scheme. The composition scheme is our topic, students. Now, the composition scheme, students, is the topic for our discussion now, students. One of the most important topics so far as your November 24 examinations are concerned. At the same time, students, it has been observed that on this topic there is many confusion that is there in the mind of the student. And you will realize, Krupa, in the session that this topic that we are going to deal will also address those twin concerns. Number one, the conceptual part, for which the clarity is missing in many of the areas. And the second one, students, is the presentation part. Again, the big challenge, the way I told you about the topic of supply, wherein you know what was the challenge which was faced by the students, that they might have understood the topic, but to reproduce the topic in the examination becomes a task. The same thing you're going to find it over here also. So again, I'm going to divide it into two parts, because in this topic there are two level of issue. One is the issue relating to the conceptual clarity, but there are a lot of confusion about small things in this topic. And the second one, students, is about the practical part, the presentation part. Okay. So now, students, those who are watching this particular video for the very first time, in the description box, I have given the telephone number. The first number, students, which is there, is my number, and in that you can WhatsApp me, add into the Telegram channel, so that you can put up in those relevant groups where you can view the lectures and access the PDF note. Students, you can just share with all of your friends and all, primarily this particular lecture series, so that all of them can benefit out of it. Tulsi, do share the lectures to all your friends and all, so that all of them can benefit. So students, now what you will do, students, herein, the composition scheme I'm going to split into two lectures. Today we will do the theory, tomorrow we'll do only the practical. So therefore tomorrow's session would only be the practical, so that all the question of the ICI from the your study material, the RTP, MTPs and the past year's papers, all those would be considered in the tomorrow's session. So students, what you are going to do, you have your notebook which is vertical. Please make it horizontal. So the notes on the composition scheme that you're going to capture would be on a horizontal level. Is that clear to all of you, students? Would be on the horizontal level, students. To prepare the notes in this particular manner. Do prepare the notes, students, in this particular manner, and that is what you're going to do. I hope that every one of you are clear with the notes making exercise, because you will require a lot of width in the notes exercise which has been there. So let's start with one of the most important topic for your examination, the composition scheme. As you know, students, the composition scheme which is there is available to the two category of person. The composition scheme is available to the dealer, the small person, the small dealer, students. So therefore, it is to the small dealer to whom this composition scheme is made available. Now, if I just give you a simple particular crux of the scheme, the crux of the scheme is that, please understand, the crux of the scheme goes like this. Students, you would know, those who have done the composition chapter, they would know that what happens is that the composition rate, students, is very low as compared to the normal rate. And these dealers will not be eligible to take the SENMAT credit. So they are denied the benefit of SENMAT credit, the ITC. That is what we understand that as. So ITC is denied, and the output liability is subject to a lower rate of tax. Now, why they do it, students? The reason is very clear. Understand that these are the small dealers. These are the small registered person. And ITC, when you talk about ITC, students, it is nothing but a huge level of compliance. When you talk about ITC, students, it's all about the compliance. Now, do you expect the compliance from the small person? Answer is no. So therefore, instead of forcing them to do the compliance, on the ITC chapter, what they have simply done in the composition scheme. So what they have done in the composition scheme is that they have denied the ITC benefit, and correspondingly, whatever is their output liability, that output liability is subject to a lower rate of tax. Subject to what? A lower rate of tax. That is what this scheme is all about. That is what the scheme is all about, students. I hope that all of you are clear with this one now. So this scheme is essentially for the small players. Now, who are the small players? Those things we are going to see, but I have just given you the crux of what this chapter is all about. Now, students, over here, if you see, point by point, students, we have to ensure that by the end of today's session, we are conceptually clear about this topic. And then in the tomorrow's class, the ICI practice material question bank plus the MTP, RTP, etc. Students, over here now, the first and the foremost part. Over here, students, as far as the scheme is concerned, so you can see there are two schemes which has been there. All of you are aware of this one, students. The first scheme, students, is about 10.1 and 10.2. And in this 10.1 and 10.2, there are three cases. Many of you would be aware of it. And the scheme 2 of composition is 10.2a. And that is about the one case, students. That is about the one case, students. And that exactly is the point. That exactly is the point, students. So that is what is that one case that we will see in this case. Scheme 1, section 10.1, 10.2. In that there are three situations which has been given to you for whom there is an eligibility. And scheme 2, which is under 10.2a, there is one situation which has been given to you. What is that? We will see in the subsequent point. So always when we discuss and when we write, we'll say this is scheme 1 or we will say this is scheme 2. Okay, students, I hope that all of you are clear with this one. I hope that all of you have written this one as well. Now the second point, students, is about the eligibility. What is the second point? The eligibility. The eligibility, students. Now if you see the eligibility, students, so if here is the registered person, be careful, students, there are two types of eligibility which has been there. Now in this context, the PFY, which is the previous financial year, and this is the CFY, which is the current financial year, and this is a registered person. So in the PFY, students, you would have seen what? So up to what, students? In this context, 150 lakhs of the aggregate turnover up to 150 lakhs. Now this aggregate turnover of 150 lakhs is for other states. Be careful, students. This is for other states. Whereas this could go to, this aggregate turnover, students, could go up to how much? Up to rupees 75 lakhs. If what, students? If it is that 8 states. I hope that all of you are aware of that 8 states. Remember that 4 in that northeast, which is also this 4. I am keeping it separate because in registration also this 4 is there. The special category states, that Nagaland, Manipur, Tripura, and Mizoram. That is a 4 one. And the next particular 8 is about Sikkim, Uttarakhand, Meghalaya, and Arunachal Pradesh. This 4 I am keeping it separate because this also comes under your registration category as well, the 10 lakhs and 20 lakhs. Nagaland, Manipur, Tripura and Mizoram, Sikkim, Uttarakhand, Meghalaya, Arunachal Pradesh. I hope that all of you are clear with this one now. So these are the 8 state students that you should be very careful about it. These are the 8 states. What exactly you get it, students? Now I think all of you are aware of it. So these are the 8 state students. Now again, for them the aggregate turnover happens to be up to rupees 75 lakhs. Okay, so this is eligibility, students. When you talk about eligibility, now be careful what I'm saying. Be careful. Eligibility for the PFY and eligibility for CFY. So there is a two eligibility which has to always be considered: eligibility of PFY, eligibility of CFY. So once you are eligible as per PFY, meaning thereby your aggregate turnover does not exceed 150 lakhs or 17 or 75 lakhs, it means that in the current previous year you are, or the current financial year, you are eligible for the composition scheme. Now you can opt for, please understand students, this is an optional scheme, so you can opt for the composition scheme in the current financial year. And if you are opting for the composition scheme in the current financial year, students, then you all are aware the eligibility in the current year is up to the aggregate turnover. Again, I'm talking about it. The eligibility in the current financial year is up to the aggregate turnover of how much? Up to 150 lakhs. Here lies the eligibility for the other states. And for that 8 state, students, for that 8 states, the aggregate turnover up to 75 lakhs. Up to 75 lakh students in this case. So this is what you are eligible in the current year for the aggregate turnover up to this. Please understand herein, when I talk about eligibility, you have to highlight whether it is the preceding financial year or the current financial year. When we talk about the eligibility, we talk in terms of the aggregate turnover. We talk about what? The aggregate turnover, because very soon you are going to come to know that there is something known as turnover of the state, and that is where the students are too much confused in this regard. That is where the students are too much confused in this regard. So repeat with me, students. When we talk about the eligibility has to be seen for both the years. Which are the both the years? The previous financial year and the current financial year. And if you are talking about eligibility, you will check out what? The aggregate turnover in the previous financial year and the aggregate turnover in the current financial year. And if the aggregate turnover, if in the previous financial year does not exceed 150 lakhs or 75 lakhs as the case may be, then in the current financial year you are eligible for the composition scheme. And if you opt for the composition scheme, in that situation your eligibility under the scheme is up to the aggregate turnover of your eligibility under the scheme in the current financial year is up to the aggregate turnover of 150 lakhs or up to aggregate turnover of 75 lakhs as the case may be. Mark my word, students, I'm specifically emphasizing aggregate turnover as far as the eligibility is concerned for both the years. Which are the both the years? The preceding financial year and the current financial year. And what is the eligibility for the current financial year? If I am eligible under the composition scheme and I opt for the composition scheme in the current financial year, in that particular case, the eligibility under the scheme is up to the aggregate turnover of 150 lakhs or 75 lakhs as the case may be. Up to the aggregate turnover of 150 lakhs or 75 lakhs as the case may be. Is that point clear to all of you, students? Every one of you, and that exactly is the game. So eligibility, for the last time I'm repeating this part, have to be seen for both the years. And whenever we talk about eligibility, you will always associate which term? The aggregate turnover. Did you realize up till now, students, this final point? And now this is point number A. So now comes point number B. Point number B, students. Now this is about the scheme 2. So one point number A, students, was technically under scheme 1. So this is your scheme 1. A is scheme 1. And now comes scheme 2, students. Now comes scheme 2. And what is scheme 2? As you can see for yourself. In the scheme 2, students, can you see that? Again the same thing. The previous financial year and the current financial year. And in the previous financial year, the aggregate turnover up to how much? Up to 50 lakhs. 50 lakhs for all the states. Here for all the states. Scheme 2, for which section 10(2)(a) is applicable, applies. There is no such bifurcation that for 8 states different turnover, for remaining other there is a different turnover, nothing like that for all the states. And if that is the case, students, now the eligibility. If you are eligible in the current financial year and you opt for the composition scheme in the current financial year, in that particular case, students, the aggregate turnover primarily up to how much? Up to rupees 50 lakhs. Primarily, you will be eligible for composition scheme, as per which the GST as per the composition rate would be made applicable. GST as per the composition rate, students, would be made applicable. Is that point clear to all of you? So can you see this? Both the case. I hope that all of you are clear with this one. So this is your point number 2. This is all about the eligibility that we have discussed in this regard. Now, students, coming to point number 3, we will discuss about the procedure. What is the procedure in this regard? So when you talk about the procedure, point number 3, because understand ICI is very smart, students, in this cases, huh? Very smart. In fact, I have seen certain questions of yours in which they have asked the procedures also in the composition scheme, but not as an independent question. You will find these procedure being put up in the case study. And one of the items of your case study requires you to talk about the procedure under the composition scheme. How they are drafting the question, that we will see tomorrow. But therefore, you should know what are the procedure and how distinct that they are and as per the normal scheme. How distinct that they are when you are comparing it with the normal scheme. That needs to be known, students. Can't get away with it. Now, if you see about this one, students, as far as the procedures are concerned, just initially, students, you will find the new person, students, if he wants to deal with it, a new person who wants to, students, if he wants to opt for the composition scheme, means like for example, say for example you became a CA and immediately you want to opt for the composition scheme when you are doing a practice, then you will have to apply for registration, and what, students, and in the registration and the registration and the registration should be sought as a composite dealer, indeed, Jyoti. For a new person. So this point number 3, students, you just give the heading of point number 3, procedures. Point number 3, procedure. You need to sort that registration as a composite dealer. And if, students, you are an existing person, then you should be aware of it. As far as the existing person is concerned, he need to, students, intimate to the portal before what? Before the commencement of the next financial year, So he need to intimate to the portal, intimate to the portal, before what? Before the beginning of the financial year. Accordingly, students, what will happen over here? In this case, effective would be the date of registration, and here the effectiveness, students, would be 1st April of the 1st April of the financial year. Is that point clear to all of you, students? That is the point. Indeed. No, not date of declaration. It is the date of 1st April of the financial year, the next financial year, that the composition scheme will begin. This effectiveness is about for the composition scheme of students. When the composition scheme will become effective, that is the point which I have made you write over here. When the composition scheme will become effective, that is the point which I have made you write over here. Now the points which I am going to write would be common for both. The points, students, which I am now going to write would be common for both. Okay. Now in this context, students, the composition dealer will issue what? Will issue, students, the bill of supply. That is to say, he cannot and he can never issue tax invoice. Issue bill of supply. In that case, cannot issue. Cannot. What he cannot do? Point number one. Issue tax invoice. Point number two. Show the GST amount. Show the GST amount. In BOS. What is BOS? Board of Studies. Bill of supply. He cannot show the GST amount in bill of supply. And the third point, students, as you know, in this context, is what? The third point, students. So first is issue of the tax invoice. Second one is about the show. He cannot show the GST amount in the bill of supply, and he cannot collect the GST from the customer. Even without showing it in the invoice, there can be a tendency amongst the dealer that even though they may not have shown, but outside they might ask for the GST which he has paid under the composition scheme, that he might try to collect it from the customer. He can't do that. The scheme itself provide cannot collect GST from the customer. From the customers. Cannot do that, students. The crime. Yeah, Jyoti. Next point, students. This is an important one, students. As you know, here the composition dealer are eligible to pay the GST on quarterly basis. Pay the GST on quarterly basis. So quarterly basis they will have to make the payment. And students, the due date to make the payment on quarterly basis will arise when? Arise on 18th of next month following the relevant quarter. The due date will arise on 18th of next month following the relevant quarter. And as far as the last quarter is concerned, which ends on 31st of March, as far as the last quarter is concerned, which ends on 31st of March, the due date will be 18th of, the due date, students, will be 18th of what? Indeed, 18th of April. So you don't say that for the last quarter, sir, we'll take 18th of 31st of March. No, 18th of April. Is that point clear to all of you, students? Every one of you? Not 30th of April, 18th of April. I hope that all of you are clear with this one, students. Now, quarterly payment and their regular return would be annual. So, although they are paying the quarterly payment, but the return would be annual. The regular return, students, would be annual. That exactly the point, students. So therefore, please take a note of it. Quarterly payment, quarterly tax payment, quarterly tax payment by 18th of next month following the relevant quarter. Following the relevant quarter. After that, regular return, students. Their regular return, GSTR 4. This GSTR 4, students, they will file by 30th of April of next year. So, Jyoti, what you have said about 30th of April is about regular return of next financial year. That is for regular return. So, this is, students, as per section 39. This is as per section 39. Now, their annual return, that is CMP 04. Indeed. And the quarterly payment that you do is CMP 08. The annual return, students, section 44. That, students, annual return is GSTR-INA, and this annual return GSTR-INA is 31st of December of the next financial year. 31st December of the next financial year. That is their annual return. So regular return, they don't file quarterly. The regular return only once for the composition dealer. So please see yourself that the compliance burden is getting reduced, because that is the objective. That is what I told you, that reduce their rate and ensure that they get the most simplified compliance. Because if you burden them with more level of compliance, then the entire scheme or the GST law will get fractured. It will get defeated. Neither they will do it, and we unnecessarily will keep on chasing these people. So just like your presumptive income under PGBP 44AD, 44ADA, what is that philosophy? That we don't want to chase these people. Let's not have much of compliance. No books of accounts, no audit. That is the entire philosophy. And give them a presumptive rate. Same thing happens over here. That is the logic behind it. Lower rate, take the ITC away, because ITC has got many compliance. So lower rate on the output liability, take the ITC away, and instead of monthly particular payment, make them a quarterly payment. Instead of regular returns, make them the returns only once, to be filed on 30th of April of the next financial year, and the annual return, as we know, happens to be 31st of December. I hope that all of you are clear with this one. Now, if you know about these people, students, any registered person has got 3 ledger account. Any registered person, students, has got a 3 ledger account. And this 3 ledger account, students, as you know, is the electronic liability ledger, electronic cash ledger, and electronic, indeed, credit ledger. But a composition dealer, students, has only 2 particular ledger. What is that? Electronic liability ledger and electronic cash ledger. The electronic credit ledger is not maintained for the only reason that they don't get credit. They don't get credit. So what is considered is ELL and ECL is what they make it. What about ECRL? Do they do it? Answer is electronic credit ledger, not to be made at all. Have you all completed up till here? All set, students? All of you are clear with this one up till here now? Now, students, if I ask you one question, supposingly a person has got 2 branches. One in Mumbai, another is in Hyderabad. Branch 1 makes an intimation to the portal. Branch 1 makes an intimation to the portal that they want to do the composition scheme. Branch 1 wants to make an intimation that they want to opt for the composition scheme from the next financial year, because that and they have complied with the terms and the condition. Now you tell me, in that case, if branch 1, which is in Mumbai, if they make an intimation to the portal that from the next financial year they want to go with the composition scheme, whether branch 2 in Hyderabad, will they also will be required to follow the composition scheme? Or you will say that, sir, branch 2 is a distinct person. Who is branch 2? It is a deemed distinct person. So if branch 1 has made the intimation in the portal to go with this composition scheme, whether that will burden branch 2 also to take it further to the composition scheme, that now even deemed distinct person that is in Hyderabad, they would also be forced to follow the composition scheme? That is the question before all of you. What is your take, Jyoti? Quickly, students. Very quickly. The train is going, students. Quickly, the train is moving. Tulsi. What about the others? Quickly, students. Deemed distinct person or separate person. They have a separate GSTIN, and hence, if Mumbai branch has taken or has made the intimation in the portal that from the next financial year they would want to go with this composition scheme, then whether that will compel even Hyderabad to opt for the composition scheme from 1st of April next financial year? That is a question, and the answer is yes, students. That is a game. It's not on the basis of GSTN. What you see is the PAN based. If it is the same PAN, be careful now. If it is the same PAN, in that particular case, you might have more than one place of business across the country. And if one particular place of business makes an intimation to the portal that from the next financial year, the composition scheme has to be made applicable, then it will make all the other place of business also it will make also the other place of business to opt mandatorily towards the composition scheme from the next financial year. It is mandatory now for them. You can't get away with it. You can't get away with it, students. That's the beauty of it. So if Mumbai branch intimates that from the next 1st April they would want to go with this composition scheme, Hyderabad branch also will have to then go with the composition scheme from the next financial year. Now, my next question is also from this only, students. Mumbai branch has made the turnover of, say, 100 lakhs. Hyderabad branch has made the turnover of 100 lakhs in the preceding financial year. Okay. In this example, Mumbai branch can make an application to the portal or intimation to the portal that it wants to go with the composition scheme from the next financial year? Can it make an intimation to the portal? Mumbai branch, can it make an intimation to the portal that from the next financial year it want to go with the composition scheme? In this case study, in this example, What is your take, students, in this regard? Mumbai branch, previous financial year, the turnover is 100 lakhs. Hyderabad branch, previous financial year, the turnover is 100 lakhs. Mumbai branch is making an application or making an intimation to the portal that from the next financial year, it wants to go with the compositions. Can that intimation be done by Mumbai branch? Can they do it? Tulsi, indeed. Even the aggregate turnover now, students, has to be seen on PAN basis. That exactly is the game, Kavita. That exactly is the game. Aggregate turnover also has to be seen from the PAN basis, and therefore, in this case, you will aggregate the turnover, and therefore, in that case, because it is crossing more than 150 lakhs in the previous financial year, therefore, in the current financial year, they are not eligible for the composition scheme, hence they cannot opt. But let's try to modify this example. Mumbai it is 60, Hyderabad it is 50, and Mumbai is making an intimation to the portal that from the next financial year it wants to go with this composition scheme. Then Hyderabad mandatorily will have to opt for what? Opt for this composition scheme. They don't have any choice. Now Hyderabad probably will say that Mumbai, if you want to opt, you better opt. Why you are dragging us in this case? And Hyderabad doesn't want it. And do you know why Hyderabad doesn't want it? Because Hyderabad has got a lot of ITC. It has taken a lot of ITC students, Hyderabad. Because they have done a lot of purchase recently. And because of that lot of purchase recently, they have got a lot of ITC with them. That is the story of Hyderabad. Now with this Mumbai branch, they making an intimation. Hyderabad is in fix now. Why? Because Hyderabad knows that the moment they go in the composition scheme, whatever is the ITC that they have availed will have to be reversed. Now, ITC students, I will discuss this ITC in the ITC topic. I will not use the ITC concept in this topic because ITC would be a separate discussion altogether. Therefore, I will not involve ITC in my discussion in this topic. ITC would be separately being discussed. But just for the overall conceptual and conceptual explanation, Hyderabad doesn't want to go with this scheme. Hyderabad doesn't want to go with this scheme. Why? Because it has got a lot of ITC, and it knows that if it goes with the ITC now, sorry, if it goes with the composition scheme, then whatever ITC that it has availed, that will have to be reversed. But Mumbai is adamant. No, I have already have opted. I have made the intimation. I want to take it. And because I want to take it, you will be dragged. Because it is PAN based. So you will be dragged. So you also now opt. Hyderabad says, I will teach you a lesson, Mumbai. I'll teach you a lesson. How it will teach the lesson? Can anyone tell a trick where Hyderabad can teach the lesson to Mumbai in this case? Hyderabad branch can teach a lesson to Mumbai students in this case. Is there a way out where Hyderabad can teach one lesson to Mumbai? So 1st April of the financial year, both Hyderabad and Mumbai enters into the scheme. Hyderabad, Mumbai, because they have opted, and Hyderabad, because of this PAN-based concept, unwillingly, Hyderabad also have to opt now. Unwillingly. Now, Hyderabad wants to teach the lesson. You know what Hyderabad should do? In this case, Hyderabad, in this case, students, to teach the lesson, should do only one thing. You know what it is? Do one interstate supply. Do one interstate supply. It should send one goods to Mumbai. That Hyderabad should send what? Should send one goods to Mumbai. The moment they send one goods to Mumbai, primarily, it becomes what? Interstate supply. Interstate supply. And you will know, many of you will be knowing that there are some prohibited supplies. Students, there are some prohibited supply. If you do a prohibited supply in the current financial year, immediately you will have to exit the scheme. If you do a prohibited supply in the current financial year, immediately you should what? You have to exit the scheme. And if you have to exit the scheme, it is not the Hyderabad who will only exit, even Mumbai will have to exit. So this is a lesson that Hyderabad can teach to Mumbai in this case. The lesson of their life today. What Hyderabad should do? Immediately they should send one goods to Mumbai so that it becomes an interstate. It becomes an interstate supply. And the moment it is interstate supply, prohibited supply, out from the game. You have to make an exit because it's a prohibited supply. So immediately they have to do the exit. And that's exactly the point, students. I hope that all of you are clear with this one. We'll see the prohibited supply bit later, but just I wanted to take you through on this conceptual discussion that we were having. Anyway, students, please write. In this case, all POB means place of business, fan based, all products and services are covered. Here you can write selectivity to the scheme not allowed. Selectivity, students, to the scheme not allowed. So say for example, Mumbai is making product A, Hyderabad is making product B, or say Mumbai itself is making product A and product B. Forget Hyderabad for a time being now. So Mumbai itself is making product A and product B. Mumbai says that I want to go with the composition scheme only for product A. Product B, I want to go as per the normal provision. Can it do it? Answer is no. If you want to go with the composition, you have to go in totality. Selectivity is not possible. Selectivity is not possible. I hope that all of you are clear with this one, students. Every one of you. And that exactly the point. The procedures are over, students. Point number 3. Procedures are over. Now the big one, students. Now the big one comes. Is that composition rate. Please see first the columns that you have to make in this regard. The point number 4 is the composition rates. So first one was about the scheme, second one was about the eligibility, third one was about the procedure, and the fourth one is about the composition rate. In the composition rate, students, the various columns that you will have to make, serial number, the scheme, section, eligible, registered person. So just keep some length on eligible registered person. After that, GST liability. Now comes the big one. Turnover. And last, students, is marginal service. Last one, students, can you see this? That is the reason why I told you to make it horizontal, the entire notes. This was the reason. Have you all copied down this particular table? Serial number, scheme, section, eligible, related person, GST liability, turnover, and finally the marginal services. So as I told you, students, in the first scheme, scheme number 1, didn't I told you, students? There are 3 cases in scheme 1, and in scheme 2, there is only 1 case. So first we will target the scheme 1, and as I told you, students, there will be 3 cases. Scheme 1. So all the first 3 serial number would be scheme 1 only. First 3 serial number, students, would be scheme 1 only, and the section for scheme 1 is 10.1 and 10.2. 10.1 and 10.2 are the section number, students. So now, to whom applicable students? Eligible registered person. So this is the manufacturer supplier students. Manufacturer supplier of goods other than notified goods. Other than notified goods, because notified goods are the prohibited goods. Other than the notified goods. Fine, students. GST liability, students, would be careful now, 1% of what? Either sentence. Turnover of the state or UT. You see that? Now this 1% technically is 0.5% and 0.5%. 1% of the turnover in the state or the union territory. 0.5% CGST, 0.5% SGST. Now be careful, students, what we are discussing. This turnover of the state, when we talk about it, what is the turnover that you're going to take? So you are going to take here the turnover as taxable supply as well as the exempted supply. Both the taxable supply as well as the exempted supply. Both you're going to take. Marginal service, I will put it at the end because this marginal service would be common for the first 3 points. Because it is common for first 3 points, I'll put it towards the end. Marginal service. Now let me come to point number 2. Scheme herein is again scheme number 1. Sections are the same, 10.1 and 10.2. And here, students, is about what? Schedule 2. Schedule 2, para 6b, which is nothing but the restaurant service. Restaurant service, students. This is a restaurant service. Again, 5% off. 5% of what? Same turnover of the state or union territory. You should know that this 5% is nothing but 2.5% and 2.5%, as the case may be. And here also, no, that inward supplies of RCM will not come into play in this context. The turnover means this is all about the output supply. Okay. Over here, students, in this case, again the same thing. Taxable supplies plus the exempt supplies. Both of them would be there for this second category also. So on that taxable supply plus the exempt supply, you will apply the 5%, which means 2.5% CGST, 2.5% SGST. Come to point number 3. Again, this is for scheme number 1. This is not schedule 1, scheme 1. And sections are the same. Now here, students, any other supply for composition scheme under section what, students? 10.1 and 10.2. For composition scheme for 10.1 and 10.2, students. This is for whom? For the trader. Are you aware of it, students? This is for whom? For the trader. So, students, this is for whom? For the trader. For the manufacturer, it is the first serial point. The second one is for the restaurant service. And the third one, any other supply of goods. You can write like this, students. Any other supply for goods for composition scheme under section 10.1 and 10.2. In the bracket, I have written trader. In the bracket, I have written trader. Now, here it is 1% off of the same thing. 1% of the turnover of the state. Turnover of the state, students, or the UT. In this context, again the same thing. 0.5%, 0.5%. Be careful, students, as I told you over here. What exactly it is? Here only the taxable supply will come. Turnover for the third category is only the taxable supply, which means that the exempt supply will not be considered while determining the composite GST liability for scheme number 1 applicable in the third case, and third case, who are the players involved under the composition scheme? It is a trader of the goods. It is a trader of the goods, students. So say for example, students, say for example, they are telling you that in the current year, a particular trader, now just a very simple example, just see how it will change the answer for first and the third one. So I have my aggregate turnover, students, is say 140 lakhs. My aggregate turnover is 140 lakhs in the current financial year. In that 140 lakhs, 20 lakhs is the exempt turnover. In that 140 lakhs, 20 lakhs is the exempt turnover. So the question is that 20 lakhs of the exempt turnover, in the first case, when I'm a manufacturer, I will have to pay GST at 1% on entire 140 lakhs. I have to pay the GST on entire 140 lakhs at 1%. That is case number one for the manufacturer. But when it comes to a trader, students, in this case, the trader will be paying GST at 1% only on that 120 lakhs. Only on 120 lakhs. Which means that the other 20 lakhs, which represents an exempt turnover, will not be subject to the composite tax liability under this scheme. That is eligible only for scheme 1, case number 3. But all the other two case of scheme 1, whatever is the applicable composition rate will be applied to both the turnover, which are the two turnover, taxable as well as the exempt supply. I hope that all of you are very clear about it, everyone. So don't you think that the question has to be read very, very carefully about, are you talking about a manufacturer or talking about the trader? That's exactly the point. Now comes the marginal services, students. Now, students, you would know that this particular marginal service came very recently. So, students, what is the scenario? Like, I am a supplier of computer and laptop. Now, obviously, students, being a supplier of computer and laptop, I have also started the repairing of computer and laptop as a service entity. I have also started the service of repairing of the computer and laptop. Why is it so? The business itself demands. See, I am under the composition scheme. And because I am under the composition scheme, I know that, okay, scheme number 1 only talks about the goods. And what the good says? Good says that if you supply the goods, primarily, you will be eligible under the composition scheme. That is what scheme 1 is all about. But what I am seeing is that okay, I was only supplying the goods, but I am seeing my competitor, he, along with supply of the goods, he is also entertaining the customer for what? For the services. He is also entertaining the customer, students, for services. Services of what? So whenever a customer is coming, say for example, for any repair of the laptop, he is available. He is putting up his labor for doing the service or repair of the laptop and computer. So many of the customer are going to my competitor. Many of the customer are going to my competitor. Now I am, in fact, because I am in the composition scheme, I know that it is only about the supply of goods in serial number 1 and serial number 3 for scheme number 1, isn't it? For serial number 2, it is restaurant service. But other than 2, 1 and 3 is only about the goods, whether as a manufacturer or as a trader. So it became the business, to do the business became difficult under the composition scheme. And people who just wanted to do a marginal service of what? Repair and all. Their main is only supply of goods. They want to do the marginal service. Just because that they are in the composition scheme, they are not allowed to do this any services. The government recognizes this compulsion of these composition dealers, that in order to survive in the market, these dealers will have to supply some element of what? Some element of service also. And that is the reason why, students, they gave them this flexibility, and as per this flexibility, they are allowed to do marginal service. But because the word is marginal, it means only a small proportion should constitute the supply of service for these dealer of goods. Only the small proportion should constitute as a supply of service for these dealers under scheme number 1. And what is that small proportion? They have defined the same. So therefore, marginal service, students, for scheme number 1 only for scheme 1. That is the point 1 that you have to take into account. This particular thing may provide such dealer such dealer may provide service other than which service other than the restaurant service. Those students who have yet to join the batch, just ensure to put up this message in the description box. The number is given, the first number. You can do the WhatsApp in this case. So such dealer may provide service other than what? Other than the restaurant service. Obviously, no, restaurant service is specifically covered. So the service that we are talking about it has to be other than restaurant service. Of the value, what is the value, students? Any idea of that? Of the value not exceeding, not exceeding what? Indeed, 10% of the turnover in the state, or the UT, or the UT, or the UT in the, be careful now, in the previous financial year. So obviously this 10% benchmark is of the turnover in the state or UT in the previous financial year. The turnover in the state or UT or in the previous financial year. So whatever is the turnover in the state or the UT in the previous financial year, you will take 10% of it. Or what? Or rupees 5 lakhs, whichever is, or rupees 5 lakhs, whichever is higher. I hope that all of you are clear with this one. See. So this covers my scheme number 1. I now go to scheme number 2. Students, I now go to scheme number 2. And as per scheme number 2, this is 10-2A, students. See that? This is 10-2A. What exactly it is? Who is covered in 10-2A, students? Be careful. Registered person not eligible under composition scheme levy of 10-1 and 10-2, comma, but eligible to opt for composition scheme under 10-2A. Registered person not eligible under composition scheme levy of 10-1 and 10-2, but eligible to opt for the composition scheme under section 10-2A. Now, who are generally covered here? If you talk about it, so essentially, students, the person or the registered person who are covered in 10-2A are the service providers, supplier of services. So the person who is registered as a supplier of service, person who are registered as a supplier of service, they are the one who are covered under 10-2A. The person who are registered as a supplier of service. They are the one who are covered under 10(2)(a). Tulsi. Now, what is the rate for them, students, in this context? So, the rates are also known to you in this regard. So, 6% of the same thing, turnover of the state or UT in this regard. Turnover of the state or UT in this regard. And the turnover would be taxable service plus the exempt service. Taxable plus the exempt service. Marginal service is not applicable. Here it is not applicable. Marginal service column is not applicable. Is that point clear to all of you? Now, students, please be careful. You will find when we do tomorrow the case study, students, when we do tomorrow the case study, you will find that some of the questions which you will know through the case study that we are going to do tomorrow, students. One of the questions says that here is a person, registered person, who is in the beauty parlor service. Beauty parlor service. And as you know, students, in the beauty parlor, the customers may also purchase some of the items which is kept in the parlor. The customer may purchase some of the items which are kept in the parlor in this case. So therefore, the question to all of you is in this regard: if the customer would be purchasing some of the items which are being kept in the parlor, then in that situation, will this case will fall under Schedule 1 or Scheme 1, sorry, or Scheme 2? Will it fall under the Scheme 1, students, or Scheme 2? What is your take? We'll see. Scheme 1 or Scheme 2? Good. So, students, as you know, in this case, it would be Scheme 2 only. Because Scheme 2 is applicable, students, for the registered person. Which registered person? The person who is registered as what? As supplier of service. Who is registered as what? Supplier of service. And if incidentally, students, just a second. And if incidentally, if he is selling what? If incidentally, students, if he is selling the products in the course of his provision of service, then it is all fine. He is in scheme number 2. Now, the question that arises in the mind of many of the students that, sir, is there any upper limit of how much is the good that could be supplied? So, unlike in the case of scheme 1, where they have given an upper limit for marginal service, there is no upper limit for how much of the goods that could be supplied in scheme number 2, which therefore means that in scheme number 2, the overall limit which is applicable of 50 lakhs, the same only would be consumed by both service as well as goods. Both only would be consumed by both service as well as goods. The upper limit of 50 lakhs. So it could be like 30 lakhs of service, 20 lakhs of goods, doesn't matter. You cannot say, sir, 20 lakhs of goods is too high, doesn't matter. This case, it could be. Another example which I can give you, students, is the coaching class. So say for example, a student from they are taking the lectures. So I would be, if I have to go with the composition scheme, I would go under 10(2)(a), supplier of service in this context. Now, obviously, a student is taking my lectures. At the same time, the students are also maybe through the portal or through the website, they are purchasing the books also. So that is supply of goods. So in any case, for me, the turnover primarily of 50 lakhs will be consumed both for service as well as goods. So it could be any proportion. Unlike in the case of scheme number one, wherein your 150 lakhs of your eligible turnover, that consumption, in that the consumption of marginal service could be maximum how much, 10% or 5 lakhs, whichever is higher. That is a maximum consumption in that 150 lakhs for that marginal service, and the balance would be for the manufacturer of the goods, or the trader of the goods, or the restaurant service as the case may be, so that is only for scheme number one, not for scheme number two, students. I hope that every one of you are clear with this one. Any doubt, students? If you have got, do let me know right now. That exactly is the point, students. Now you write, students, a very important note in this context. That exactly is the game. A note. So serial number, students. Be careful. Huh? Eligibility. This would be a big this thing. Or may I say, write like this. Second one would be turnover. So serial number, turnover, have the space, the section applicable, very small. And now this would be big one. The value of supply. Value of supply made by such person from 1st of April of the financial year up to the date when he becomes liable for registration under the Act. Value of supply made by such person from 1st of April of the financial year up to the date when he becomes liable for the liable for registration under the Act. So that is the case. And the last particular item, friends, the value of exempt supply of service provided by extending deposit, loans and advances. Use the phrase DLA insofar as the consideration is represented by interest. Have you all copied on this? This are the column, students. This is the very important note, students, and you will realize the impact of this notes in the practicals that we all do. The impact of these notes in the practical, students, that we all do. Have you all copied on this one? Every one of you. Value of exempt supply of service provided by extending deposit, loans and advance in the bracket I've written DLA in so far as the consideration is represented by interest. So far as the consideration is represented by interest. Have you all copied on this one, students? Let's start with this one, truth. Let's start. So serial number 1 in this context. Now the first one, students, as you all know, is about the eligibility. Now when you talk about eligibility in the turnover, when you talk about eligibility, I told you already, students, eligibility is in respect of the aggregate turnover. When you talk about eligibility, it is for the aggregate turnover, and aggregate turnover, students, is for preceding financial year and it is for current financial year. Eligibility, students, is in respect of the aggregate turnover for the preceding financial year and for the current financial year. And the section which is involved in this regard, students, and the section that is involved, which would be section number 10 only, students. Section 10. If you can just put up over here itself this remark, section number 10. And in this section, students, explanation number 1. Explanation number 1. Now be careful, students. The first column which you can see over here is value of supply made by such person from 1st of April of the financial year up to the date when he becomes liable for registration under the Act. Be careful. Students, the eligibility which we are talking about it, for which we take into account the aggregate turnover, the eligibility, students, is essentially to know whether a person is big or small. The eligibility is essentially to know what? Whether the person is big or small. That is what the purpose of eligibility is. To identify whether he is big or small. And if that is what is the purpose, now you tell me, students, in that case. So, to determine whether he is big or small, will I consider the entire turnover that he has done from zero to last? The answer is yes. I just need to know how much big that person is. So therefore, will I consider from 0 to that first 20 lakhs or first 10 lakhs, which is about, or first 40 lakhs, because in the registration topic, student, there is one more limit for goods. For goods, students, you should know, you may be knowing also that for goods, there are two limits for registration, 20 lakhs and 40 lakhs. For goods, I'm talking about. Generally, what we say, 10 lakh and 20 lakhs. 10 lakhs is for that 4 state and 20 lakhs is the other cases. But for goods, there is another limit of 40 lakhs. 20 and 40 is for goods. Anyway, students. So, say for example, from 0 to 20 lakhs turnover, will I consider also that in determining the eligibility or in determining my aggregate turnover? Will I consider the turnover also from 0 to 20 lakhs to determine the eligibility? Answer is yes. This 0 to 20 lakhs are not considered when you have to calculate a tax liability. 0 to 20 lakhs are not to be considered when you have to calculate a tax liability. But whether this 0 to 20 lakhs, will that be considered if we have to what? If we have to determine the eligibility, and the answer is yes. And that is the reason why, students, in this particular context, to determine the eligibility, this 0 to 20 lakhs will be included. So include 0 to 20, students, to determine the eligibility of the aggregate turnover, whether it has crossed 150 lakhs or 75 lakhs or 50 lakhs, as the case may be. Now this point, students, I must say, as a rule now, I must say to all of you, students, this is an exempt supply. Already mentioned to you. This is what? An exempt supply. If I have to give you a thumb rule, the thumb rule of this is that this particular interest element will be excluded from all the turnover, students. This particular interest element will be excluded from all the turnover. So you will always exclude, students, this for all the turnover. We will see through examples also, don't worry. But as a thumb rule, I am not telling to you. This particular 20 lakhs, this particular exempt supply, which is there, will be excluded for the calculation of turnover. Is that point clear to all of you? Every one of you? That's exactly the point. So this is for the eligibility in this regard. Now, in that context, students, the second one is about the composition rate. The first one was about this one, and the second one is about the composition rates. Now, composition rates are applied on what? Rates are applied on the turnover in the state. Turnover in the state. Now, turnover in the state, students, which is there, or the UT, depending upon what it is. Now, this is for the current financial year. This is for the current financial year. Turnover is in the current financial year only you will calculate the liability. Na? In the current financial year, students, you will calculate the liability. How you calculate the composition tax liability? By applying the rate. Rate on what? On the turnover of the state or the union territory. So therefore, this is what it is. Now, this is as per explanation number 2 of section 10. Explanation number 2 of section 10. Now, in this, students, be careful. So, tell me now, if you have to calculate a liability, so now this is a new person who is just starting the business. Now, obviously, his last year turnover was 0, so he is eligible from day 1. Now, from 0 to 20 lakhs of his turnover, will you be calculating the GST liability? Whether he is under the normal scheme or whether he is in the composition scheme, from 0 to 20 lakhs or 0 to 10 lakhs, will you be calculating the liability? Whether it is under the normal scheme or under the composition scheme? And the answer is no. So therefore, in that case, this particular part would be excluded. So now can you see the difference over here? So for aggregate turnover to decide the eligibility is for what? To know whether you are a big person or you are a small person. That is the reason of the eligibility. For that, you will include what? You will include those particular amount. You will include in that case. To understand that whether you have reached the level of 150 lakhs or not. But when you have to calculate the liability at that point of time, that part, the first 0 to 20 lakhs, up till the time when you are liable for registration, that particular portion of your turnover, you will not be considering for determining the liability, whether it is under the normal scheme or whether it is under the composition scheme as the case may be. Or under the composition scheme as the case may be. Now, if you see over here in the next particular context, value of exempt supply of service provided by extending deposit and all. I told you a thumb rule, always students, always exclude. Always exclude. This will never form in the liability also. In this context. We'll see small case studies also in this context. Now the third one, students, which is about the marginal service. In the marginal service, students, in the marginal service, what exactly it is? Turnover in the state, here also. Turnover in the state or UT. And this is for the previous financial year. For marginal service. Because here we used to take 10%. Now this is, as per students, the proviso. This is the proviso. That is what we do. So this is the proviso to this section 10. Now over here also, as I told you, should exclude. And what about this one, students? What do you think of it logically? Just tell me. So say, for example, the last year was his first year. And in this case, say in the second year. So last year he has made the turnover of, so last year was the first year. And he has made a turnover of 120 lakhs. So obviously he would have registered at 20 lakhs. He has become registered person on 20 lakhs. Now in the current year, students, now you tell me, in this case, when you have to decide for the marginal service, second year starts here. So last year, technically, you have done 120 lakhs, of which 0 to 20 lakhs, students, as you can see over here, 0 to 20 lakhs, as you can see, is this particular point. Isn't it? Now you quickly, students, answer me this particular thing. Quickly. Quickly answer this one, students. So students, can you tell me how much is the limit in the next year for marginal service? Did you calculate the marginal service in this case? 10%. What would be the limit, upper limit? Please tell me. Marginal service. Give me the answer. From the numerical itself, we will conclude. From the numerical itself, we will conclude. Quickly. So Tulsi, you are saying 12 lakhs is the answer. Means you are comparing 10% of 120 lakhs with 5 lakhs, whichever is higher. Higher is 12 lakhs. All the other students are also getting the same answer. All the other students are also getting the same answer or not? Quickly. Everyone are saying 12 lakhs. So if you all are saying 12 lakhs, so obviously what you have done? Don't you think that you have included at 20 lakhs also? Technically speaking, what you have done? If you are taking 120 lakhs, so from 0 to 120 lakhs, which means that in that consideration, this 120 lakh students, any case, are getting included. So sorry. So this is getting included of the last year in a way. So the bottom line is that you have to take the full turnover. What is the bottom line, students? You have to take the full turnover. I hope that all of you are clear with this. Is that point clear to all of you? Every one of you? Have you all written? Perfect, students. Now, before students, I give you the examples on based on what we have done right now. Before we go with the example, students, just write the next particular point. So before we are in the example part, students, just write the next particular point in this particular context. Which is it? Point number? Eligibility is done. Composition rate. I think composition rate, no? Point number 4 was composition rate. After that, this was a note that you've written. So point number 5, students. So what is this point number 5? This is about prohibited supply. This is about prohibited supply. And be careful, this is the prohibited supply in the current financial year. Highlight this part. I'll give you the example also, but highlight this part. This is in the current financial year, students. Which are the prohibited supply? In this case, non-taxable supply, interstate supply, supply through ECU, in that ECU, where the TCS under section 52 is collected, and the manufacturer of notified. Now this is for both scheme 1 and scheme 2 students. Both for scheme 1 and scheme 2. Repeat what, Rupa? This is a prohibited supply. Prohibited supply. Current financial year, Schedule 1 and Schedule 2. So point number 1, non-taxable supply. Point number 2, interstate supply. Point number 3, supply through e-commerce, where the TCS under 52 is what is collected. And the last one, students, happens to be manufacturer of the notified goods. Marginal service example, what I have told was that in the last year you started the service. Last year was this thing. Last year you started your supply of goods. That was the first year. So last year you made 120 lakhs turnover. In that 120 lakhs, the first 20 lakhs was your towards what? Towards your this thing, na? Towards the registration. First 20 lakhs. So what was my question that I have asked to all of you was that tell me for the marginal service limit of 10%, how much is the limit of 10% you are going to calculate? So you said that 10% would be of 120 lakhs. 10% would be of 120 lakhs of the last year. In that 120 lakhs, even that 20 lakhs is included. In that 120 lakhs, even that 20 lakhs is included. So what does it mean? It means that when you have to take for the marginal service, this 10% of the turnover of the state of the last year, and if the last year happens to be your first year, and in that first year, obviously from 0 to 20 lakhs would be your first 20 lakhs turnover, and from 20 lakhs to balance, you will have the tax that you would have paid. But for the marginal service, when we are talking about the turnover of the last financial year, the turnover of the state in the last financial year, in that particular case, we have to see the entire turnover from 0 to what? To that particular thing, to the turnover that you have achieved. So if you have achieved the turnover of 120 lakhs in that particular case, the turnover of the state in the last year was 120 lakhs in that context. So how much would be the limit of marginal service in the current year? 12 lakhs. So that is a 12 lakhs figure. That is how we have arrived. So we were giving the justification of that 12 lakhs amount. How we got this 12 lakhs? So 12 lakhs is that entire 120 lakhs that we took off the last year. And if in that 120 lakhs, even that first 20 lakhs is also there. So that first 20 lakhs is it to be included? Obviously, the entire 120 lakhs we have taken for that 10%. So first 20 lakhs was also included in that. Isn't it? That is what I was discussing. Now, friends, very quickly to just highlight on this particular point. Non-taxable supply, students, you all know. What is this non-taxable supply? So I told you, students, this is the prohibited supply of the current financial year, which implies that in the last financial year, say for example, students, in the last financial year, I have done interstate supply. In the previous financial year, students, I have done the interstate supply. Am I prohibited from the scheme? Am I prohibited from the scheme, students? Am I prohibited from the scheme in this regard? And the answer is no. This, I might have done all that thing in the last year. But if in the current year, I have not done any of this prohibition, in the current year, students, if I have not done any of this prohibition, then I am not prohibited. So what has to be seen is the current year threshold. That whether in the current year did this. If you have done it, then you are out of the game. If you have done it, students, then you are out of the game. Last year you might have done this, doesn't matter. But if in the current year you have done 1 or 2 or 3 or 4, then you have to make an exit. Okay. Now I'll give you one example, students. Be careful. In the state of Gujarat, this registered person was from state of Gujarat. Some of his supplies he is doing to non-SEZ unit in the state of Gujarat. Some of the supplies he is doing in the current year only, I'm talking about it. Some of his supplies he is doing to the non-SEZ in the state of Gujarat, and some of the supplies he is doing to the SEZ unit in the state of Gujarat. Is he eligible for the scheme in this case? Or will he have to make an exit from this case? If he has opted for the composition scheme, will he have to make an exit? This case. Will he have to make an exit, students, in this case is the question to all of you. What is your take on that? Indeed. Didn't we discuss in our first class only, students? This was our first class lecture. And I told you that the supply to SEZ is an interstate supply. The supply to SEZ was an interstate supply, and the fact that supply to SEZ is an interstate supply, you will have to make an exit to the scheme. You will have to make an exit to the scheme. Another example, students, what about the export if I do? If I've done the export of the goods in the current financial year, so I've got say 10 lakhs of order for which I've done the export. Is it a prohibited supply? Is it the prohibited supply? In this case, yes, it is. Again, the first class, students. Remember the first class? What I told you? What is export, students? What is interstate supply? Interstate supply is a supply outside the state. That outside the state can be anything. It can be other state. It could be United States. We don't know. Outside the states could be outside the other state in India, or outside the state, outside India. I don't know. But it should be outside the state. If it is outside the state, it is interstate. And it can go in the same country or out in the other country also. Doesn't matter. And that is also interstate supply. So some of the examples from interstate is typical example which we have discussed in our first class. Typical example of the interstate was what, students? In this case, SEZ supply, export supply. These are the typical example, students. That exactly is the game. That exactly is the game, students. And I hope that all of you are clear with this one. Every one of you. Now, supposing, students, as you know, I was giving you my example. I would go under the composition scheme under section 10(2)(a), students. That is scheme number 2. That is scheme number 2. And if I would go under the composition scheme, which is scheme number 2, my question therefore to all of you is this, that you find in my website the products which are being listed. You find in my website the products are being listed. And if you are finding in my website the products are being listed, so my next question to all of you is this, that is the supply through e-commerce? Is the supply, students, through the e-commerce? What is your take on that? Because if you say that, yes, sir, you are supplying through e-commerce, in that case, you would be, your supply would be prohibited supply, and therefore you will have to make an exit from the composition scheme. So is this a supply through the e-commerce for which I need to now make an exit from the scheme? And to that, students, the answer is no. This is my own website. This is my own website. It is the website of the e-commerce operator through which if I am doing a supply, through which if I am doing the supply, then that is what is considered as a prohibited supply. So the example could be Amazon and Flipkart. If through that, if I'm putting up my product, that is what is known as the prohibited supply, not through my own website. Is that clear to all of you, students? So that is one thing that you should be careful about it. Now with that, students, the sixth one is the example. Example, students. Small example, students, to just draw on this particular point. Supposing this is an unregistered person, students. Unregistered person in the previous financial year. And the total turnover that he has done is 10 lakhs only in the last year. 10 lakhs. Say this is year 0. So current year also he is an unregistered person, students. This is year number 1. This is year number 1. Okay, now obviously students, in this context, is he eligible for the composition scheme, the aggregate turnover? So the aggregate turnover, you can see this is aggregate turnover. So obviously to this one, composition scheme in this case is available. Composition scheme, students, in this case is available. Now over here, students, obviously this is 20 lakhs, the first 20 lakhs of the turnover over here. And then thereafter, students, there is an extra. Then this he is reaching, students. See, the total one was over here 140 lakhs. So how much is the extra that he did? Extra 120 lakhs. Extra 120 lakhs, students. Now tell me that is this much of the portion. Is it turnover of the state for GST rate? For GST tax, it has to be excluded. It is not considered to be turnover of the state for the current year. When you have to calculate the GST, obviously I told you now, when you have to calculate the GST, you will not consider this. GST cannot be calculated on this, neither under the normal case nor under the composition case. So now this is the 20 lakhs. Now once you reach 20 lakhs, students, you become a taxable person. Once you reach 20 lakhs, you become a taxable person. What is this taxable person? That is the date becoming liable for registration. Liable for registration. Now on this extra, this thing, composition tax. Now will this be a turnover of the state? And the answer is yes. And therefore, in this context, you will have to apply the GST at composition. As per composition scheme. Now, this is year number 2 now, students. Year 2. Now, over here, he is a registered person. Here now, he is a registered person. Now, supposing, students, over here, in this context, he has touched 200 lakhs. Now, in that, there is this 150 lakhs. Now, obviously, students, first, the aggregate turnover of the previous financial year, PFI. How much you want to take? Aggregate turnover of the previous financial year, students. When you have to take eligibility. In eligibility, students, whether you are going to consider this 20 lakhs or not, first 20 lakhs or not, for deciding the eligibility, whether you are going to consider this first 20 lakhs or not, yes. So for the purpose of this one, your aggregate turnover of the previous financial year is 140 lakhs. 140 lakhs, and therefore composition scheme, is it applicable? And the answer is yes. Over here. Now this also becomes, students, eligibility in the current year. Students, now you tell me, this is a turnover of the state. turnover of the state, on which this is turnover of the state, GST at composition scheme would be applicable. GST at the composition scheme would be applicable, isn't it? Now this 150, your eligibility is over. This is the aggregate turnover again. Eligibility is over now. So eligibility gets over in that 150 lakhs. So I'm using the term aggregate turnover again. As I told you, eligibility is used twice. One for the previous financial year and for the current financial year to decide the eligibility in the current financial year, that up to 150 lakhs, your eligibility is there. After that, it is going to get over. And therefore, on that next, if the eligibility is over on the next 50 lakhs, GST as per normal rate. Is that point clear to all of you? Every one of you students? This is how you need to take into account now. I hope that all of you are clear with this example. Read this example very carefully, friend. This is where you need to be very, very careful about it. Composition scheme. Now let's take the second example, students. Two small examples more. So this is example number 1. Or two more small examples. And we are through. The second example, students, in this particular context. Supposing this is a registered person and this is the previous financial year and this is the current financial year. Now over here, students, in the previous financial year, the aggregate turnover was say 200 lakhs. Now this aggregate turnover of 200 lakhs comprises of three things. One is the 120 lakhs of the taxable supply. Second was, students, about the 60 lakhs exempt supply 1. Exempt supply 1. I'll use the word ES1. And this exempt supply 1, students, was about interest on that DLA, deposit, loans and advance. And the third one, students, is that remaining 40 lakhs. Sorry, 20 lakhs. 20 lakhs. This is ES2. Other exempt supply. Okay, so this is the data which has been given to all of you. 120 lakhs was a taxable supply. 60 lakhs was the exempt supply, ES1. Interest on, in that 60 lakhs was the exempt supply on account of interest on deposit, loan and advance. And that balance 20 lakhs is the exempt supply to other exempt supply. Now question therefore is, in this context, students, that registered person over here, the aggregate turnover of the previous financial year, PFI, what is that aggregate turnover that I'm going to take? The aggregate turnover, students, that I'm going to take would be what? So in that aggregate turnover, students, I am going to exclude this. In that aggregate turnover, I'm just going to exclude this part. What is that part? This particular part, and therefore it becomes 140 lakhs. So if it is 140 lakhs, then whether composition scheme for the current financial year, is it applicable? And the answer is yes. Composition scheme for the current financial year is applicable. Now, up to the current financial year, the turnover that has been reached was 160 lakhs. Up to the current financial year, the turnover that has been reached was 160 lakhs. In that, the taxable supply was 130 lakhs. Exempt supply 1. What is exempt supply 1? The interest is 15 lakhs. Exempt supply 2 is 15 lakhs. So over here, primarily, tell me, GST at composition scheme. Calculate the GST at composition scheme. So GST rate into turnover of the state. GST rate into turnover of the state. What is the turnover of the state in this case? That you are going to take. Turnover of the state. Now, if I have to give you, this is the composition scheme number 1 only, students. Scheme number 1. I'm not interested in scheme number 2. And in scheme number 1, there are 3 cases. Case 1 and case 2. Case 1 and case 2. And there is a third case also, trader of the goods. Case 3. So whatever the GST rate into turnover of the state. This is scheme number 1, wherein there are got 3 cases, case 1 and case 2, and then there is a case 3. So for case 1 and case 2, what would be the turnover of the state? For case 1 and case 2, what would be the turnover of the state? The turnover of the state, students, in this case would be what? 130 lakhs and 15 lakhs. 130 lakhs and 15 lakhs. Exempt supply number 1, which is for the interest, that would always be excluded. So what would be there, students, in this case would be 130 plus 15 lakhs. 15 lakhs is what? ES2, by the way. So this is 145. And for case 3, students, case 3, I told you, it is only taxable supply. For trader, it is only the taxable supply. So if it is trader, so therefore, students, it is only 1. So applicable GST rate on 130 lakhs. Applicable GST rate on 130 lakhs. Is that point clear to all of you, students? Have you done this composition scheme in this particular manner, students? These are such a nitty-gritty things, wherein if you get it wrong, you're all gone, students. Now you tell me, students, in this context, before I go to the next particular part, what is the aggregate turnover, students, which I'm going to consider? Aggregate turnover for the current financial year. Am I out of the scheme? So aggregate turnover I have to see, no? In the current financial year, because then I have to see whether my aggregate turnover for eligibility in the next year. What is the this thing? Aggregate turnover. Students, tell me in this case, what is the aggregate turnover? Because for that, I will have to see the eligibility in the next year also. Therefore, aggregate turnover. How much is the aggregate turnover? Is it 160 lakhs? We'll see. Aggregate turnover, students. Indeed. Aggregate turnover, students, can you see? Again, these are the only 2 things. What would be excluded, students, in the aggregate turnover would be, yes, you got it right, students. Interest part would be excluded. For everything, interest is excluded. So therefore, my aggregate turnover, students, would be what? 145 lakhs. So now, if this is the aggregate turnover, students, tell me 145 lakhs in the next financial year. Next financial year, whether he will be eligible for composition scheme? Composition scheme, students, will it be available? Composition scheme, will it be available, students? And the answer is, did you all got hold with this one? Every one of you. If this chapter is such, students, if you don't do diligently, I'm telling you, after some point of time, you will big time goof up. Now, what I have done is that to the 6 points and 3 example, your entire composition scheme is done. On the day of the examination, students, you can revise only this. That is it. 10 minutes, your composition scheme is over. The presentation part, which we will do tomorrow, that structure you need to know how to write. But that practice we will do, and you will know how to write. And then once you are done with that, you are sorted out. So on the day of the examination, you don't have to refer the presentation part. On the day of the examination, these 6 points and the 3 examples. You are through with the composition scheme completely, and all the marks need to be pocketed now. That is what you're going to do. So the last example, students, I'm going to give you for the marginal services, because that marginal services is that 10%, no? In this context. So again, same thing, students, registered person in this context. So registered person, but I think I have already given you just this example already we discussed. Anyways, so this for the first year, students, you already know, no? This for the first year. So 0 to say 140, 0 to 140 lakhs. Now in this 0 to 140 lakhs, so 140 lakhs. In this, tell me, there was an interest, students, on deposit, loans and advance of how much? 40 lakhs. In that, students, there was interest on deposit, loans and advance of 40 lakhs. Now, first of all, now you tell me aggregate turnover. How much is aggregate turnover? Aggregate turnover of the previous financial year. To decide the eligibility, we will see the previous financial year and the current financial year. So first go to the previous financial year. How much is the aggregate turnover in the previous financial year? 100 lakhs. All of you agree? So am I eligible in this context? Eligible for composition scheme? Eligible for composition scheme? Now you tell me here, current year 150 lakhs is the eligibility of the aggregate turnover. Anyway, what is the maximum, students, limit? Maximum limit for marginal service? Scheme number 1. In scheme number 1, what is the maximum limit for the marginal service? Maximum limit for marginal service in scheme number 1. 5 lakhs would be compared with what? 10% of 10% of 100 lakhs. 40 lakhs would be out from the turnover of the state of the preceding financial year. Will exclude turnover of the state of the preceding financial year, will exclude interest. So therefore it is 140 minus 40. So therefore in this case it is how much? 10 lakhs is the real gain. I hope that all of you are clear with this one now. Every one of you. This covers up your entire composition. Did you got the confidence, students? And if you have indeed got the confidence, students, you will have to ensure to just spread this lecture, because obviously when you are also filling the validation, you will have to spread about this lecture to all your friends and all. This would be my fees for this particular batch for passing up this particular knowledge to all of you, and the input from my side. So my fees is you need to spread this particular lectures to all of your friends across, so that they also get benefited out of it. Fine, students. That is one thing that you need to contribute at this particular side. So therefore now, students, and as you know, the numbers any case are given in the description box. The first number happens to be my number. They can just do the WhatsApp, and accordingly they will be connected, and you know the procedure. They will be put up in the group, and from there they can see the lecture. Still there is a time, students, for them to see it and bounce back. Somewhere in the month of October you are telling the November students to see this lecture, so that might be too late for them all. Fine. Just do let them also know, and let they also take the benefit out of this particular batch, so that every one of you evolve and excel and qualify, and even they can make their parents happy on January 20th. See you then, students, tomorrow night 9:15. We will do now only practicals. So theory is done. I think the PDF already I've shared with you in the Telegram group. So therefore now we'll do the practicals in the tomorrow's. Okay, and we'll finish it off. And that would be again formatted. Now you will see the way it is written. It is very difficult to write like that. Even though you may be knowing the concept, but still you might struggle to write it properly, student. You might struggle to write it properly, student. And even after knowing so much, if you don't get full marks, then what's the use of doing all that, isn't it? We'll see tomorrow how to crack this one up. Take care. Bye bye. Good night to all of you.